This Thursday sees the ECB step forward with a likely 25 basis point cut coming our way. That comes hot on the heels of an FOMC meeting that's likely to reiterate their patience and data-dependent approach. So that differential is interesting. And it comes also at a time where people are selling into the tech sector in the US. We, of course, have tech earnings this week, but the DeepSeek and news coming out of China does have people questioning whether the US is the place to be. So is this going to be the week where we see people really starting to focus a little bit more on areas, maybe China, but also on Europe as we see further interest rate cuts and people wanting to find the place that's going to be potentially shielded a little bit from this tech sell-off? So here is the outlook for the week. We've already seen one German survey coming out on Monday, but Wednesday we see GfK consumer climate, and Thursday we've got GDP data coming out, unemployment, economic sentiment survey, and then of course we've got the ECB interest rate decision, expectation 25 basis point cut across both the repo and the deposit facility rate here. And that's a continuation of a trend, right? The ECB hasn't really paused in their rate cuts, whereas the likes of the US and to a large extent the UK, there's a great degree of hesitancy and fears around a potential reflation move coming into play once again. Crucially, inflation will start to come back into focus as well on Friday, where we see the German inflation rate coming in as we head into the further week, where next week we're going to see CPI numbers out of the Eurozone as a whole. So inflation, GDP, that ECB interest rate decision, it's all creating a heady mix that should provide for increasing volatility for the likes of the euro and for some of the equity markets within the region. It does come off the back of a PMI survey in the week just gone, where we actually saw better than expected numbers for many of the different metrics. Crucially, we saw a move towards the upside and above that 50 threshold for the Eurozone composite PMI number, and that really was driven by strength in manufacturing sector. Not to say strength per se, but ultimately it's contracting, but at a slower pace, because we saw a nice bump in terms of that manufacturing PMI, and services actually moved towards the downside on this occasion. So does that mean that the Eurozone economy is suddenly great because it's above that 50 threshold and the ECB doesn't really need to act? I wouldn't necessarily go as far as that. You can see in terms of inflation, there are some sort of warning signs at the moment in terms of the uptick that we've seen for Eurozone inflation. And by and large, you can see that's driven by some countries, but not all countries. At the bottom end of this chart, you can see the likes of Italy at 1.25. You can also see France at 1.32. So significantly below that 2% target. And then other areas, 28% of the CPI metric comes from Germany, and they're at 2.64. They've been moving towards the upside. We've got Spain, which is 11% of the overall metric. That's 2.8%. And the Eurozone number at the moment, 2.4%. So still not too far away from target. These annualized figures, I think, are particularly interesting at the moment because it gives you a gauge of exactly where things are moving over the near term rather than just using a one-year metric, which is what people generally look at. Year-on-year inflation could be 10%, but there's a good chance that could all be stripped out in a few months if all of that happened in a few big months, and then since then it's all been fine. So that overall year-on-year figure doesn't necessarily tell the whole underlying story. So what I like to see is how are things tracking over the past 3 months? What is that consistent with if you're looking at that over a year's period, and how much for a 6 month? And what you can see here is that you've got the likes of Canada and the Eurozone that really stand out compared to the likes of the US and the UK. 6 month annualized for the US, 3%, 3.9% on the 3 month annualized. So it's actually quickening in the US. Same kind of story with the UK, 4% on the 3 months and 2.2% on the 6 months. We've also seen that quickening for the Eurozone, but you can see over both of these metrics, they still remain below that 2%. The last 3 months are annualized out at 1.5%. The 6 months annualize out at 0.8%. In terms of the core inflation, a similar kind of picture in many ways, but we haven't really seen that resurgence in terms of price pressures, but they are still too elevated for the US and the UK. because in no small part because of the effects of energy over the near term, which has been sort of moving higher once again recently, well, prior to Trump coming into power. So the 6-month annualized core CPI figure in the US, 3.2, 3.3 for the 3-month. So the US is not on a pathway to 2%. The UK, 2.5%, and then more recently on the 3-month, that's annualized out to 2.7%. So once again, we're not really in the UK in a position where we're actually going to see 2% over for the time being. Instead, it looks likely that we're going to see sort of mid-twos for some time yet. And then you look at the Eurozone, 0.7 on the 6 months and 0.5 on the 3 months. This really points towards the Eurozone being in a position where, if anything, they're sort of implored to cut more rather than thinking, oh, do you think we can get away with it? You can definitely get away with it if you're potentially going to see core inflation moving below 1%. In terms of interest rates, you can already see that the Eurozone has been at it in a pretty heavy manner. They were one of the first to cut. You can see here the SNB cut first. Then we saw a joint move with the Bank of Canada and the ECB at the same time. And then from then you can see it's 1, 2, 3, 4. So 4 rate cuts from the ECB so far, well below many of these other central banks. And most notably the likes of the Bank of England, the likes of the Federal Reserve. Those are the kind of banks that at the moment, they're sort of lagging when it comes to their sort of pace of easing. As we look forward, we can see here that what is important here is, okay, what's going to happen this time around? Okay, that is important. But by and large, markets are pricing a 91% chance that we see a 25 basis point cut anyway from the ECB. So the idea of them cutting rates is probably not going to be a market moving event in itself. But beyond that, you can see, where do we start seeing the question marks and where do markets see them stopping, right? And that's when we think we're probably going to see some sort of movements. So you can see, okay, 71 plus 7%. So near enough 80% chance of a cut in March. Then in April, things starting getting a little bit iffy, pretty much sort of 50% chance that we see another cut from there. And then June is pretty much stagnant from there onwards for back end of the year. That doesn't necessarily mean that we will only see that, number of cuts, but it seems like at the moment markets are pricing in a rate cut every meeting until the mid part of the year, and then pretty much no more cuts from there onwards. Now, that may be how it plays out, but maybe it's not. And certainly as we get closer to that point in time, the ability to price towards more rate cuts or to price away from that and say this is going to be the sort of neutral rate that we want to end at, the terminal rate, that's going to be really important. So any guidance on how far they go and how low they go will be really interesting as we go forward. Certainly, I think part of the story at the moment in terms of markets is about this DeepSeek news over in China, and it's bringing question marks around the US tech sector. Of course, NVIDIA selling chips at a huge margin. That might go out the window if all of a sudden people are able to run models and AI systems on a much cheaper budget and much sort of older chips as well. There's also the fact that you've got this big tech sort of surge in terms of buying all these super expensive chips, and ultimately, they may have overspent. They may have paid for too much of something they don't need too much of, and they're actually able to reconfigure towards doing things on the cheap and getting pretty similar results. That remains to be seen, and we don't actually know if, when the Chinese come out and say we've done this on a shoestring budget, we don't actually know if that's real. We don't know if they managed to get NVIDIA's chips illegally and then actually utilized it in a different, behind the scenes, and instead of saying, oh yeah, look what we've done, and by the way, we've been using NVIDIA's chips, but even though we're not allowed to import them, they might have just said, oh, we've done this in a shoestring budget. That brings the possibility that people think, oh, China's the place to be, because China, if everyone's buying US stocks on the AI boom and what could happen in terms of AI, because all of the big AI stocks and all the spending is happening in the US, what happens if China prove that they are in the same position, that they've caught up and that they don't need to do it at the same kind of cost? All of a sudden, people start to see value in Chinese stocks, and people crucially stop seeing value in big tech because they start to try and think, we've seen a massive run up in terms of big tech on the back of AI. So do we need a recalibration, and how long is that going to last? So this is the price to earnings ratio compared between, I probably should have put Chinese market in here as well, but we're looking at the Eurozone, of course, at the moment with the ECB. So this is the chart, the likes of the CAC, the DAX, the FTSE 100, S&P 500 and the NASDAQ when we're looking at their price to earnings ratio. And you can see here that at the top end of this is the NASDAQ, because that highlights the massive valuations within the tech sector in particular. Below that, we've got the S&P 500, still well over and above its European counterparts. And at the bottom, we have these European counterparts trying to play catch up. And this catch up means that people are starting to attach more value to these indices. So, is this the point in time where people start to reallocate away from the US? Now, bear in mind, this capital has to go somewhere, right? And so if people are selling up out of their US tech positions, and if European markets are continuing to rise because they're not impacted to the same degree, will people just sit on cash? Are people going to go into bonds? Or will people say, well, actually, Europe's looking pretty decent at the moment, and, maybe I'll reallocate there. Or over in China, that's another argument. But certainly there is a possibility that we see money flowing from one place to another, and that could actually benefit Eurozone stocks. So this is the CAC. And essentially what we're looking at the moment is a market that is on a big rebound. You can see here in the monthly time frame, this pull back into the 76.4 Fibonacci, where we bottomed out here in sort of November, December, leading us into a really rampant rise here in January. Over the near term, we can see here that we are sort of failing a little bit on Friday, but you can see the selling pressure from today. A lot of it has been made up, and we're back in the green. Not truly in the green, though, of course, because we've gapped lower, but this candle in itself is in the green. And certainly there could be some arguments coming into play around the possibility that this is going to be an area where people could possibly look to start to invest in. So if we look at, say, there we go. So if we look at the S&P 500 compared with the DAX, you can see here over the long term, we've got long underperformance here, which is the sort of red line, pink line, purple line, call it what you want. But you've got long-term underperformance here for French markets compared to the US markets, right? And so essentially what we're looking at here is a potential catch-up play. Now, of course, if you look at the French index, what drives that index? A lot of it is sort of luxury, consumer, and non-durable, essentially discretionary stuff, the like of Hermes and the like. And those kind of companies will do well when the Chinese are doing well. And so if we are potentially going to see this as the point where the Chinese market starts to potentially bottom out because people see value there, I think that should benefit the likes of the CAC as well. So we've rebounded from this Fibonacci level on 2 occasions, 76.4. We've created this double bottom formation. Yes, we're going to see some jitters within the markets at the moment because we're questioning, exactly what's happening and how much we're going to see contagion between sort of US losses and European. But I think there's an argument to be had that we potentially start to see people gradually favor what's happening in France. Of course, this is still the sort of onset of this story, so you're going to have to see how it plays out. But certainly, if people start to or continue to question what's happening over in the US with tech stocks, I think, European markets could be really interesting. This sort of resistance level that we have here, let's just move that to the right, make it regular for some. Okay, well, 78.14 essentially we've got here. That's a near-term support level at the moment. We're sort of turning higher from there. I wouldn't be surprised to see the bulls come back into play, and certainly in a week that's going to be dominated by talk around the ECB and around the possibility of them easing time and time again as we move, particularly through the first half of this year. It builds on that narrative, because I think on Wednesday, when we hear from the Federal Reserve, the story is going to have to be data dependency, because they're worried about what's happening with Trump. Does Trump bring inflation? We still have a lot of question marks, and there's a lot of uncertainty for the Federal Reserve. So they're not in a position where they're suddenly going to say, we're going to ease, 4 times this year. It's just not going to happen. Markets are pricing 1 to 2 interest rate cuts from the Federal Reserve. The ECB have already cut rates. They're going to cut rates further pretty much at every meeting over the next few months. And so, it does provide the basis for potential outperformance when it comes to European markets. Now, in terms of the FX space, let me just quickly jump back onto the slides. And we can see here that the relationship between UK and Eurozone yields. Let's get rid of the disclaimer there. So you can see here the differential between UK yields and Eurozone yield or Euro area yields has provided the basis for downside when it comes to Euro sterling. Now, recently, we've seen both the 10-year yield for the Eurozone rise relative to the UK, and we've seen the likes of Euro sterling moving towards the upside as well. So is that going to last? Not sure. Part of it's going to come down to the UK side of the equation, certainly. But if we look at the trend is to move towards the downside, and generally it does resolve in terms of weakness for this. And we can see in terms of the chart itself that Euro sterling at the moment is back up the sort of top end of this descending trend line. You can see it's essentially been sort of channeling lower over the past year odd. And we've rallied up into this area where I think is really interesting, because we've got the Bollinger Band, the upper Bollinger Band, we tentatively moved through, but we didn't close above it. And previous occasions that we've come back up to this trend line resistance, we've done exactly the same, moved above it and then broken lower, moved into it, and we actually sort of guided upwards into trend line resistance from there, but never closed above that Bollinger Band and then broke lower. We sort of tapped it here and moved lower, moved up in through trend line resistance, close to that upper Bollinger Band and rolled over. So this is a really interesting point in time. And you can see also momentum starting to shift here, because you can see that rally up into that sort of overbought territory for the stochastic, starting to roll over here with the fact that the stochastic's now back below the 80 threshold. And we can see a similar kind of thing here on the daily time frame. It's sort of high highs, higher lows on that stochastic, and that's starting to turn now with this lower low and lower high for the stochastic. So I think there's a good chance that we do see the bears come back into play from here onwards for Euro sterling. We're seeing some sort of volatility at the moment, but as long as price action remains below this near-term swing high, which is 846, then near-term upside, I think, is likely to be sold into as we potentially start to roll over once again following this rally into the Bollinger resistance, the trendline resistance, and with the stochastics rolling over. It's going to be a really interesting story to watch out for as we move throughout the week. I hope this has been useful for you guys. The ECB, just one of 3 big interest rate decisions taking place over the course of this week. I've also produced a FOMC preview, so make sure to check that out as well. But yeah, plenty to sink our teeth into. And this news coming out of China has really put the cat amongst the pigeons when it comes to financial markets at the moment. And potentially Europe and European indices could be a beneficiary of that.